What is a Ponzi scheme? A Ponzi scheme is a fraudulent investment scheme that entices investors with high rates of return and little risk. A Ponzi scheme is a fraudulent investment operation in which money is collected from later participants to pay returns to earlier investors. This is comparable to a pyramid scam in that both rely on new investors' money being used to reimburse the previous funders. When the influx of new investors stops and there isn't enough money to go around, both Ponzi schemes and pyramid schemes finally hit their bottom. The plans then start to fall apart. Clients are promised a substantial payoff at little to no risk in a Ponzi scheme, an investment fraud. Companies that operate Ponzi schemes put all of their efforts towards luring new investors. The returns to the initial investors are paid using this new revenue, which is designated as a profit from a legal transaction. Ponzi schemes depend on a steady stream of new investments to keep giving older investors profits. The plan fails when this flow is exhausted. Origins of the Ponzi scheme. In 1920, a conman named Charles Ponzi inspired the term Ponzi scheme. However, the earliest known instances of this type of investment fraud date to the middle to late 1800s and were carried out by Sarah Howe in the US and Adele Spitzer in Germany. In reality, two different works by Charles Dickens, Martin Chuzzlewit, which was released in 1844, and Little Dorrit, which was published in 1857, describe the techniques of what later came to be known as the Ponzi scheme. The U.S. Postal Service was the primary target of Charles Ponzi's inaugural fraud in 1919. International reply coupons, created at the time by the Postal Service, allowing a sender to buy postage in advance and include it in their message. The recipient would use the coupon to purchase the priority airmail postage stamps at their neighborhood post office in order to reply. Arbitrage is the term for this type of exchange, which is a legal activity. But Ponzi grew avaricious and increased his attempts. He offered returns of 50% in 45 days or 100% in 90 days under the name of his business, Securities Exchange Company. Investors became interested in him right away as a result of his success with the postage stamp plan. Ponzi simply transferred the funds without investing them, telling the investors they had made money. The Boston Post started looking into the Securities Exchange Company in August 1920, just as the scam was coming to an end. Following the newspaper's investigation, federal agents detained Ponzi on August 12, 1920, and he was charged with many charges of mail fraud. Ponzi received a 5-year prison sentence in November 1920. One of the largest examples, Madoff. The Ponzi scheme idea persisted beyond 1920. Both technology and the Ponzi scam evolved over time. Bernard Madoff was found guilty in 2008 of operating a Ponzi scheme in which trade reports were fabricated to imply a client was making money on non-existent assets. Madoff marketed the split strike conversion investment method, which made use of stock and option ownership in the S&P 100, as a means of investing. In order to tamper with his records, Madoff would utilize blue-chip stocks, which have easily available historical trade data. Then, in order to produce the desired periodic return, reported false transactions that never took place. Investors started to withdraw money from Madoff's company during the 2008 global financial crisis, revealing the firm's true financial situation and its illiquid character. Madoff claimed that his company owes roughly 4,800 customers a total of $50 billion in obligations. Madoff was given a sentence of 150 years in prison and had to lose $170 billion in assets. He passed away in prison on April 14, 2021. Summary: the Ponzi scam brings in new investors by promising them a substantial payoff with little to no risk, which creates returns for previous investors. The fraudulent investment scheme's basic idea is to reimburse the initial backers with money from future investors. Companies that run Ponzi schemes concentrate all of their efforts on finding new investors because without them, the scheme will run out of money. The SEC has provided advice on potential Ponzi scheme red flags, such as guarantees of returns or unregistered investment vehicles with the SEC. Bernie Madoff perpetrated the largest Ponzi scam, defrauding thousands of investors of billions of dollars. Thanks for watching. Don't forget to subscribe.